Thanks for joining us today. The question is how do you make money with commercial real estate? You should be paying attention to this right now because there's a lot of opportunities over the next year to 2 years that are going to become available where if you know the right things about commercial real estate, you're going to be able to potentially get very high returns. So that's exactly what we're diving in today. And with us today is Mike Sowers. Now, Mike is a licensed contractor and broker in the state of Minnesota, and he holds the CCIM designation, which is the highest designation you could achieve in commercial real estate. Now, after investing in residential real estate through flipping, wholesaling, and rentals for over 12 years, he was sick of overnight HGTV experts and ready for something bigger, a lot bigger. So he sold his multi-million-dollar remodeling business, modified his residential investing system for commercial use, and added an extra digit to every single deal. Now, today, as Mike is the CEO and founder of Commercial Investors Group and the host of the Creative Commercial Real Estate podcast, sharing his methods for graduating from residential to commercial investing using equity partners. Now, he has a platform called Commercial Investing Mastery that helps students nationwide learn how to follow the exact methods he teaches in his book. Mike, thanks for joining us today.
Oh, such an honor to be on the show. Thank you.
So what do you think? Why choose commercial real estate investing over residential?
Oh, well, that is a very good question. Thank you for that one, because as you mentioned in my intro there, I was a house flipper and residential investor for over a decade. And once I got into commercial and realized how much more fun, exciting, and lucrative it was, I literally broke off the rearview mirror, and I'll never go back. I sold everything I have residential. You know, all things being similar, money, time, everything else being the same, the interactions that I have with small business owners who are my tenants really drives the value of my hours that I live in the work environment. And what I mean by that is in residential, you're dealing with whatever, first-time home buyers who are buying your flip, or you're dealing with renters, right? If you're doing the landlord route, or you're dealing with wholesalers. And the reality is, a lot of those people are great people, but the people that I get to deal with in the business realm are small entrepreneurs. We tend to buy buildings with a lot of tenants in one building, but smaller spaces. So I'm dealing directly with the CEO or the business owner. And the benefit of that to me is I get to rub shoulders with people who are winners in life, and their trajectory is northward. And I have several hundred tenants now, and I just have some of the coolest business owners, and whatever services I ever need, we have, businesses that rent from us. And, that piece of it, at some point, your scoreboard has to graduate beyond money and go to like, what's your quality of life? And so quality of life is the clear answer, but it goes beyond that. It goes scalability, right? You flip a house, it's 30 grand. You flip a commercial building, it's 300,000, or in some cases, $3 million. We've made that kind of money on individual deals. And you know what's crazy is flipping a commercial building is really not any harder than flipping one house. But you just get like 10 to 100 times the results. So there are a few things you got to learn, though. You got to learn how to lease commercial spaces. You got to learn how to raise capital from other people, and you got to learn how to analyze these bigger deals effectively. Once you can get those three skills down, you can move from residential into commercial.
Yeah, a lot of things you say is very familiar to me because I moved consumer to commercial credit space. Same thing, right? Same closing percentage, but 10x literally the income. So very relatable. It's like you do the same work, but you make 10x the money. What do you think about real estate investing versus other kinds of investing right now?
Well, I mean, the tax benefits alone make it the clear winner for investment vehicle. To give you an idea, on my stock market stuff, I'll have an EFT that follows the S&P 500, and I'm in a couple mutual funds, and I have what my financial advisor would tell me, that I have a diversified portfolio. And hey, I'm doing great if I'm consistently generating 10% per year or something like that, right? Everybody's happy, I'm winning. Well, I'm getting on my stuff that I'm investing in 30 to 40% per year, but I pay taxes on none of it because I'm cost segregating the buildings, and the tax law allows you to accelerate and completely write off certain parts of the building. So if I buy $1 million building, I might get a $300,000 write-off. But what's crazy is I'm going to get $700,000 in debt. So I'm only putting $300,000 down. So I'm literally getting almost dollar for dollar Like if I invest 300,000 into a building, I get $300,000 write-off. So if that 300,000 came from ordinary income in other parts of my businesses, I'm using this $300,000 write-off over here on the real estate investment to write off my ordinary income. And I just don't pay any income tax on the federal side. In our state of Minnesota, you still pay the state taxes, but that's what's really cool about it. And then what we do is we put together syndications. So I have a fund that's a multi-asset fund that will own multiple assets across multiple markets and multiple asset classes like retail, office, industrial, and apartments. And with that, the pro forma on that's like 16 to 19% per year. So somebody could invest in our fund, generating 16 to 19% returns, of which like 10 to 12% is paid in quarterly distributions. And then the rest is appreciation. The value of your units goes up each year. And it comes with a big depreciation. They get the same depreciation. They're literally a partner in those investments, so they get their proportionate share of the depreciation. So what do you want to do? Do you want to make 10% in the stock market and pay tax on all of it? Or do you want to make 16 to 19% in real estate and pay tax on very little of it?
Makes a lot of sense on why real estate, why commercial. So when you have properties, what do you like to do? Do you like to lease them out or do you like to flip them?
Yeah, so I always buy property with the mindset of it being a long-term hold. And the reason being is if you have the mindset that you're going to either flip the property or flip the contract, which we call wholesaling. Are you familiar with wholesaling in the residential world?
Yes, absolutely.
Yeah.
But some of our audience may not be. So you might want to speak to that.
Yeah, so wholesaling is when you get a purchase agreement on a property and then you assign your rights under that purchase agreement to somebody else for a fee. Or you can do what's called a double closing, where basically you buy it, but the same day you turn around and sell it to somebody else. And they're both essentially accomplish the same thing. It's just, do you want your end buyer to know how much you paid for it? Should there be two closings or one closing? And wholesaling is a really great way, but here's how you think about it. Wholesaling in the residential world, you might get $10, $20, $30,000 to wholesale a deal. If you're getting more than $30,000 on a residential wholesale, you're crushing it. But that's not the average, right? You might have one grand slam, but you're hitting a bunch of singles and doubles. Well, in the commercial world, it's not unusual for me to get a $200,000 or $300,000 check. And here's why. Let's say I get an $8 million building under contract, and my business plan is to buy it, put $2 million into it, fixing it up and leasing it, getting it to full occupancy. Now I'm all in at $10 million, but I'm going to go get a $7 million bank loan. I'm going to raise $3 million from my investors, and I pool their money together and we take it down. So I got $3 million in equity into the deal. Well, here's what's interesting. I took that $10 million asset, but now it's worth $13 million. See, I put $2 million into it, but I actually increased the value by $5 million. And the difference is my profit of $3 million. But since I leveraged bank financing, I only put $3 million down. So we essentially doubled our equity. And in most cases, we can accomplish that in 12 to 24 months. And so you get these incredible returns. And now you have options. Do I want to refinance and pull our initial $3 million out, give it back to the investors with a healthy return, and then they stay in the deal getting an infinite return because they no longer have any capital at risk, but they're still getting some of the upside? That's how we structure our deals. They took the risk up front, so I reward them by giving them their money back as soon as I can with a great return, and then they stay in the deal, and then they continue doing more deals with us, and they get that velocity of capital. And so when you look at it from that perspective, you can do an unlimited number of deals once you solve for being able to raise capital. And so, you know, I love the scalability of commercial real estate for that reason. But if I go into a deal and I have the mindset that I'm going to flip it, I'm going to make decisions on the remodel that maybe are cutting corners. Or if I go into it with the mindset that I'm going to assign the contract while I'm in due diligence, maybe I'm cutting corners on my due diligence because I know that I'm not going to buy it. I'm just trying to assign it to somebody else. And I'm not about cutting corners. But here's what happens. I always go in with the mindset of holding long-term for cash flow. And then I always make long-term decisions, just like the Japanese, right? I'm thinking 50 years out. What decisions am I making now so that this building is going to be in my family 50 years from now. And I always make good decisions. And guess what ends up happening? Inevitably, occasionally, one of those partners falls in love with the project and they got to move their business into this building and they want it all for themselves. And we were going to make $3 million on it. So they give me a 10% of the profit up front for an assignment fee. They cut me a check for $300,000. They make $2.7 million and they execute the business plan instead of me. That would be wholesaling. Or occasionally we buy the property and we fix it up, and halfway through the remodel, somebody makes us an unsolicited offer. Everything's for sale at the right price. The question is, if I move the equity out of the project now and put it into something else, can I get a better risk-adjusted return somewhere else than I can here? And we always constantly would analyze stuff like that. Right now, I have 3 properties that we're selling. So I'm always a seller, but I'm always a buyer as well. And I always buy with the intent to hold long-term, but I always stay open to changing my business model if it makes sense.
I love this. And a large part of what you talked about there was a really brilliant strategy of getting money and even including using equity partners. But let's start with the bank loan. In the example you gave, right? Let's say it's $10 million property, $7 million, which you're getting a bank loan for. I wouldn't imagine you can have a lot of those bank loans outstanding. Am I wrong? Like, how do you qualify for a $7 million bank loan?
Yeah, great question. So when you get up into larger loans like that, a lot of times, so there's 2 ways. One is you take that's a 70% leverage in that example. If I got a $6 million loan, any bank in the US will do the deal, and they'll do it non-recourse, 0 personal guarantees by the deal sponsors at like a 60% loan to cost. And you can get that money all day, but it brings your overall yield down because you have to raise more expensive equity. Equity is expensive, debt's cheap. But the difference between debt and equity is that if you miss your debt payments, they take your property. If you miss your equity payments, I just say, hey guys, we had a bad quarter. And then I still pay them their preferred return, but since I didn't give it to them in cash, it just accrues on their capital account. And then I pay it to them when things go better. Because look, sometimes we buy a vacant property and it's not because we weren't performing well, but we just bought a dog. And some of the properties we buy are really bad properties. Like they're either completely vacant or mismanaged or whatever. So it takes time. It takes time to renovate them. It takes time to get the income high enough to where it not only covers the operating costs, but then covers the debt service. So a lot of times we have to escrow or raise enough equity up front to cover 6, 12, 18 months of mortgage payments if we buy a fully vacant property. But my ideal property is not a fully vacant property. I love buying deals that are like, 50, 60% occupied. It generates enough net operating income to pay the debt service on day one. But then I have all the upside. So at least I'm covering my debt obligations on day one, but now I can renovate it, increase some rents, restructure some leases, fill some vacancies, put third-party management in place. Maybe they were paying every time the snow needed to be plowed. I do a fixed rate contract. I renegotiate the internet contracts. I put in all new LED lighting. I actually structure the leases so the tenants have some of the risk for utilities so that everything's not cranking at 90 degrees. We'll go in and do water efficient fixtures, automated building systems so that you're not paying somebody to lock it and unlock it every day. And then you're just doing all kinds of stuff like that in simple renovations to really lower the expenses, drive the income, which the gap there is, look, commercial real estate is the same as valuing a business. It's the net income times a multiple. That's what it's worth. The name of the game for us is increase the net income or net operating income. That is the EBITDA equivalent of a real estate project. In businesses, we call it the earnings before interest, tax, depreciation, amortization. That's the NOI or net operating income in real estate. They're the exact same thing. And then the multiple is the multiple that a business sells for. That's the PE ratio. If you go look at the stock market, what is the price divided by the earnings? That's what it is in the business world. But for some crazy reason, somebody had the idea to divide by a fraction in real estate instead of multiplying by a whole number. So in real estate, we take the net income and divide by a 6% cap rate to derive a value instead of multiplying by 13 multiple or whatever that ends up being. But it's just all a cap rate is the inverse of the multiple of the income that somebody's willing to pay.
Makes perfect sense. When you're looking at these things when repairs, how do you look at that? Like, how do you even take into account the repairs that may be needed and the cost to do those repairs?
Yeah, so there's two things you got to get really good at to make your first $1 million profit in commercial real estate investing. You got to get really good at projecting the future value, and you got to get really good at estimating the cost to get it there. In my example, I was projecting the future value at $13 million, and I projected my costs at $2 million, right, to fix it and fill it. So our software that I built, I have a proprietary software that we use internally to evaluate our deals. It's a high power sheet, but formulas can't get broken. And it also brings in data from other sources that allows me to pull comps and other things much more effectively to analyze deals. And so I would look at that deal and say, hey, it's going to be worth 13 million. It's going to cost me 2 million. My break even price is 11 million. How much money do I want to make? Well, I want to double my money, so I need to make 3 million. So my max allowable cash offer is $8 million. And that's really all it comes down to. So the question you're asking about, how do you analyze repairs? You want to be able to do that in really 3 rounds. The first round is a basic budgetary number for the purpose of making the offer. And then when you get your offer accepted, you go into round 2, which is where you actually write a formal scope of work, get concept drawings, and then get bids. And then round 3 is after you've actually closed, you sign construction contracts. Now you're getting paint colors, fixtures, you're finalizing construction drawings for permits. And then you lock in your final sworn construction statement, which is the very final round of numbers. And the numbers will keep changing as you move through this process. I think some of the mistakes people make is they don't have a process for estimating repairs quickly up front. I can walk through a commercial building and have an estimate done in about 10 minutes. Some people spend weeks doing that same thing. They're going way too far into detail because they don't have a system. They don't have a spreadsheet with all the most common line items. Like, I know that it costs me, $7,000 to remodel a bathroom if I'm doing a cosmetic update, or about 15 if I'm moving things around and doing all new partitions. So I've just figured this out because I used to own a construction company, and one of my competitive advantages there was I built an estimating software that allowed a 13-year-old to be able to estimate a kitchen remodel. And I think that was part of the reason why I was able to sell that company, is because of that software that I developed. Now, with that being said, I've taken everything I did in that company and put it into my CRE tools software, so that my franchisees can basically plug in. I have an app called the Renovation Estimator, and it's preloaded with all their market data and all the most common line items. They just go in and say, hey, what kind of project do I have? It's an office cosmetic update. Boom, it pulls in the most common 12 or 14 line items. They punch in their quantities. It spits out a number. They adjust what's my contractor fee, what's my contingency. Click a button and it ports that in as a cost into our deal analyzer, which is basically a deduct from the future value when they're figuring out how much to pay.
You talked about a lot of things, and when it comes to getting money, you really hit on 2 points: bank loans, which you talked about, what to do there. And you also talk about equity investors. How does your equity investor system work? I mean, who are these equity investors? How do you find them? And what kind of returns can I get? I guess I'm going to ask you 5 questions at one time and expect you to remember them all. Mike, that's apparently what's happening right now in my brain. So what are these equity investors? How does this whole thing work? Like, what kind of returns can I get as an equity investor? And how much money is the minimum that I could use to get in and be an equity investor?
Sure. So that is a fair amount of questions, but I think I can answer all of those one at a time. So first of all, how do we structure our partnerships? You can structure your part. Look, most people look at here's my deal structure for how I'm going to buy the property. And then they look at, here's my deal structure for how I'm going to finance the property. So the first thing I want to just shatter people's brains around is that you can actually look at both of those as one negotiation with the seller and doing a seller financing scenario. So one thing that we do that very few other investors in the commercial game do, people have figured this out in residential, right? Creative seller financing, but in commercial, it's just not as common. But we do a fair amount of contract for deeds and seller carryback loans. And so let's take that same deal and let's say I only got $500,000 and I don't want any partners. Can I convince? Now, let's say that property owner, remember my offer was $8 million. Let's say they're stuck at $9 million, right? And most people would be like, well, I can't do $9 million, Ty, because my max allowable cash offer is $8 million. And so our negotiations have failed. That's where the creative investor can say, well, look, now I'll do 8 million cash or I'll do 9 million, but here's what you have to do for me. If you want your price, I got to get my terms. And here's my terms on the $9 million deal. I'm going to do $7 million in bank financing, and then you're going to take $1.5 million second mortgage that would be subordinated to the bank loan. And we'll do a 10-year term on that at 5% interest, let's say. Now I have to raise $1.5 million less money. So now I only have to come up with $1.5 million. Or let's say I'm like, hey, I want you to do a $2.5 million second mortgage because I only want to have to come up with $500,000. So you can do a second mortgage to reduce the equity. Now, on average, I pay my equity investors 15 to 19%, let's say. That's expensive money. If I can get the seller to basically finance that portion of the deal, can I pay them a higher price because they're giving me below market rate financing? And the answer is yes, because then my weighted average cost of capital comes down, which means I can pay more and still achieve the same cash flow. So that's the first thing to solve the financing problem, is it is giving the seller a few different options to choose from. Hey, you want 9 million? Here's the terms we can do. Maybe I'll throw one out at 8.5 million on a contract for deed, 10% down, 4% interest, or $8 million cash will close in 2 months. And then I let them choose what makes the most sense for them. And here's what you think. You think everybody wants cash, but they don't actually want the cash. They want what the cash can do for them. And when you realize that a lot of people took advantage of that big depreciation on their property, they're going to pay a tremendous amount of taxes if and when they sell and they don't do a tax deferred exchange into another property. So there are benefits to doing a seller carryback or a contract for deed, because what it does is it breaks their tax liability into multiple tax calendar years as they receive the money. And therefore they're staying in the lower tax bracket each year, and it spreads it out. And a lot of them are generally older in nature, 70 years plus. They've owned these properties for a long time. They're self-managed. And some of those reasons are why they're not performing at peak performance. But I do great deals with them that are fair, and I help solve problems. I did a deal this year I closed on in July. It's this great old couple. They were managing this building themselves, and they were having to write a check for $3,000 every month to keep this thing operating. They own this building free and clear, and this was the building they had planned on for retirement. And a friend of mine brought me the deal, and she was like, hey, I feel bad for this old couple. They keep running out of money, and the building's half vacant, and every time we get an interested tenant, they don't have enough money to build out the suite, so I have to keep turning people down. Are you interested? And we dug into it, and what they wanted is they needed $4,700 a month to live for the rest of their life. And that's what they wanted. So we did a deal. I gave them $225,000 down. I didn't bring in any partners, and they financed the whole deal at 3% interest on a 15-year fixed rate deal. And I pay them $4,700 a month. And that deal is going to turn out to be phenomenal. We'll make like $600,000 or $700,000 on that. And we gave them a really fair price for what it was, and they gave us phenomenal financing terms. But here's what's interesting. They went from paying $3,000 a month to getting $4,700 a month. That's a $7,700 a month swing for them. And they were so thankful at the closing that we were going to do this. They were afraid we weren't going to follow through. And we set up on auto ACH and they get their money like clockwork and everybody's happy. So that's creative financing. Now let's talk about, if they accept my cash offer, how do I raise the equity for the $3 million? Here's how I do it. People love stability, but they also get excited about upside. And so I kind of blended the two together. And what I do is I pay people a return on their money. We call it a preferred return because it gets paid first before we split any profit. So for every dollar they put in, they get a return on that money, the same as if they were basically lending their money to the partnership that buys the property that we form. It's a new LLC typically. And we treat their money they put in as a loan. And so they get an interest on their money, if you will. The only difference between that and real interest is that if we don't have enough cash to pay it, it just accrues on their capital account instead of me being in default. That reduces my risk profile, that if we get some tenants that decide not to pay or whatever, that I'm not in default. And like I said, that's really the difference between equity and debt. But they get this interest rate on their money. Let's say it's 6, 7, or 8%. Okay. After that is paid. So if I raised the $3 million, let's say I decided for that offering to pay 8%. So that's $240,000 a year is 8% of 3 million. The first 240,000 of cash goes to the investors before we ever see a penny. But after they get their 240, every dollar after that, I split 50-50. And typically what would happen then is that their 50% plus their interest, if you will, ends up being somewhere in the low teens, 10 to 12%. Okay. But guess what they also get? For every dollar they put in, they now have $1.50 worth of equity. Because look what happened. We had a $3 million investment of capital. Our equity is now $6 million because we doubled it. But on the $3 million we created, I keep half of that. They get half of it. So their $3 million capital in is now $4.5 million. I get the other $1.5 million for doing all the work. And so for every dollar they put in, they get $1.50 back out. So depending on if I refinance or we sell it in 2 years, then all of a sudden their yield's like 30%. But if we hang on to it, the longer we hang on to it, the benefit of that back end payday gets watered down over 7 years instead of 2 years. So it brings the annual return down a little bit. At the end of the day, though, they're getting consistent, really high cash flows. They get a preference on their dividends. They get a huge tax depreciation. And they get a huge value growth in the money they put in because we're only buying properties where we can drive up the underlying income stream and then de-risk the property to increase the multiple of that income stream that a financial buyer in the market's willing to pay for it.
Really smart. If I want to be one of these type of investors, what's your minimum to get in?
100 grand for my fund that I have right now, but there's different offerings that we do. I've had some that are 25 grand. My current public offering, which is a 506c, so I can talk about it in public on a podcast. It's the CIG Value Add Fund. It's a $100 million equity fund. We're buying $500 billion in assets over the next 5 years. Here locally in Minneapolis, as well as other locations that we own franchises. We're the only commercial real estate investing franchise on planet Earth. And that's exciting to me because it gives us access to deal flow. I basically have boots on the ground in different markets, doing all the work, following our system, using our software, analyzing deals. But then we control all the data on our end because they're doing it in our software. And I think that gives us some economies of scale. And I really believe and have seen that it also allows us to achieve a level of systemization that really de-risks the investing process. So you're getting these kind of asymmetric returns, right? They're getting almost double what they would make in the stock market, but they're taking way less risk because it's backed by a very reliable and time-tested asset. Right? If a CEO at a big software company makes a bad decision or says the wrong thing to somebody in their Uber car and it gets caught on video, all of a sudden your stock plummets. You don't see those kinds of things happening in the real estate realm. And we only buy multi-tenant assets. I'm not going to take your $3 million and go buy, one McDonald's. And then if they don't decide to pay me, then we're all filing bankruptcy. Right.
Yeah.
And so when you have hundreds of different tenants, if you have a couple of tenants that default, you expect that to happen. It doesn't impact anybody. We just plan for it on the front end. So we're diversifying across a very rich tenant base as well. So, I mean, if somebody was interested in investing, here's how it works. If you invest 100 to 250, you get a 6% preferred return and then 50% of the upside. From the 250 to 500 number, we pay a 7 pref. Pref is just short for preferred return. And then at the 500 plus number, you get an 8 pref, but then you also get a seat on the board. And the board meets regularly. And you get to see some of the inner workings of the things that we have and stuff. And you also get to give us your input on who we should be using this year. Every 6 months, we revalue the portfolio in order to figure out what the unit price will be for the next 6 months, because we continue to raise capital.
Great stuff, Mike. I have a million more questions and I wish I had more time to answer them, but I know you got a bunch of information on your website. Is this the best place to go? Where's the best place to go for anybody that's interested in learning more?
Yeah, I mean, if you were looking to learn about the franchise opportunity or investing in our fund, just book a call with me. You can go to our website, which is commercialinvestorsgroup.com, and then just click on the contact tab and you should be able to book a call with me on there. I'd love to meet you and talk to you about either opportunity. The franchising opportunity is, $75,000 to $100,000 minimum commitment. And really the difference is, right, there's two parties in these deals. There's the people that do all the work, and there's the people that put the money up and do none of the work. Truly passive returns. If you want to just be passive, you can look at our fund. If you want to learn how to set up a real estate investing firm for yourself so you can do exactly what I'm doing and raise capital from other people, but do it in your market, we can help you do that under our brand name and our system and our software through our franchise company.
I love it, Mike. Thanks for coming on here with us today.
Yeah. It was exciting. Thanks for having me on.
All right. So if you're a listener watching this and this makes any sense, which it should make a lot of sense, because I talk to a lot of people on this podcast, and if you paid attention to the numbers that Mike is throwing out, it's one of, if not the highest potential returns you can have on any kind of real estate investment that I've seen, and which makes sense because, as he said in the beginning, there's a lot more money to be made on the commercial side than you're able to make on the residential side. And I think you can make it a lot faster. If you'd like to learn more about this, make sure you go to commercialinvestorsgroup.com, commercialinvestorsgroup.com. A plethora of information here. First of all, Mike has a great book, and you can get the PDF copy for free on the website. You can also be part of Commercial Investing Mastery, where just a little bit of information, you're able to access videos, podcasts, book resources, investment tools, membership options, mastery form, all of these things that you would need to be able to learn more to break into this, whether you want to be a franchisee, whether you'd like to just be a potential investor, but whether you just like to learn how this works and how this actually how Mike does this, and then maybe start to do some of this stuff on your own, whatever it may be. The key is right here on Mike's website, which is commercialinvestorsgroup.com. So make sure you visit commercialinvestorsgroup.com. Grab this book for free. It's definitely worth having. Make sure you get in when you click learn on the Commercial Investing Mastery as well. And that will give you a ton of information and details on how to succeed in this space. So thanks for tuning in. Make sure you visit commercialinvestorsgroup.com to learn more. Have a great day.